We will. Welcome to Closing Bell. I'm Mike Santoli in for Scott Wapner. This make-or-break hour begins with the bulls stumbling badly into a new month as a poor jobs report and escalating tariff threats undercut an overbought market unable to take advantage of a generally strong earnings season. Plus, we're following that late-breaking news out of the White House. President Trump calling for the firing of the head of the Bureau of Labor Statistics following today's jobs report, which include a big downward revision to prior months. We'll have a live report on that coming up, along with fresh reaction from Mohamed El-Arian. Let's take a look at the scorecard with 60 minutes left in regulation. It's all deeply red. The S&P 500 is now on pace for its worst day in about 2.5 months. It was down a little more earlier, almost 2%. Small cap Russell 2000 is now down about more than 4% for the week as a whole. The NASDAQ under pressure from some post-earnings sell-offs in Amazon and Apple. That week's jobs reading sparking a huge rally in treasuries. The two-year yield sinking to the low end of a 4-month range as the market sets much higher odds of a September Fed rate cut after having lowered those odds on Wednesday after the Fed meeting. It all takes us to our talk of the tape. Is this market coming to terms with a genuine threat to the Goldilocks economic backdrop, or is this merely another dip to be bought? Here to talk about all of it is Chris Toomey, Morgan Stanley Managing Director of Private Wealth Management. Chris, good to see you.
Thanks for having me.
Coming down. You know, August 1st, everyone talks about seasonal weakness. We certainly got a little bit of a gut check on the data front. And of course, having to come to terms with what tariffs might shake out in this new threat from the president. How are you playing it? What do you expect, let's say, for the next few weeks?
Yeah, I mean, look, this is a big week. We had a lot of big earnings. Earnings look great, like you said. Mag 7 delivered. The rest of the market delivered. We had a great GDP number. Powell comes out sounding fairly hawkish. Everything looks like it's going the way it should. We've got the dollar now back to where it was in April. And to quote Lee Corso, not so fast, right? We're in a situation where, wait a second, we're looking at the labor market. What did the Fed see and what is the market seeing right now? Now, like, taking into that consideration, though, we were in a really overbought situation, right? Volatility had come down. If you look at retail buying, retail has been fighting with the kind of the smart money, hedge funds, long only, in the sense that $75 billion has come into the market this quarter. That's at a 22% rate, 75% of which is going into passive. That's having a side-on effect with systematic hedge funds coming in. That's having a side effect with the short squeeze. So we saw meme stocks going up. We saw the most shorted stocks go up pretty dramatically. So we were due for a pullback. This is just the catalyst that's starting to realize that.
Yeah, I mean, the market often, you know, when it's time and when the conditions are right, goes in search of something to kind of create an excuse for what it has to do on the downside. On the other hand, I do think that the jobs number and the revisions may have generated a bigger rethink of just exactly how resilient the broader economy is. And, you know, where do you come down on that as to whether this raises alarms or it's just still part of the same muddle-through trend?
Look, I think there's a real question with regards to what the actual damage is for tariffs and what it's doing for economic data. I think if you look at Q1 import data, imports were up about 35%. Q2, they were down about 32%. So, you know, we're in a situation where we're seeing a lot of things moving in directions pretty rapidly. So the question is, how much did companies prepare for that, and how much is baked into these earnings that we're seeing, and what does that mean going forward? You're seeing some of this sectorally with regards to autos and airlines not necessarily doing as well, but companies that aren't as impacted by imports doing quite well. I think the real question is, you know, look at Apollo and Carlyle have been talking about this, is that inventory drag, right? You've seen inventories come down fairly dramatically. We've got, you know, a lot coming over from China. What is that going to be priced as? Is this a situation where margins are going to start to compress, or is the consumer going to start to feel it and we're going to start to see inflation come up? So this might be kind of the canary in the coal mine with regards to the fact that companies are starting to tighten their belts. They're not hiring as much, and this might be a lower growth environment than we were expecting.
You mentioned that, you know, the Mag 7 delivered on earnings. The reaction to those earnings not necessarily been to celebrate right away, and not in every case. NASDAQ 100 basically is back to where it was before any of them reported earnings. What does that tell you just in terms of what was priced in, where valuations got to, and whether this will just right itself as we move on through the quarter.
Look, I think from our standpoint, if you remember, going into the year, earnings were expected to be about 10%. They dropped down about 2.7% during Liberation Day. They're now back up to 6%, right? So we're about 3/4 of the way through earnings. 80% are beating versus 67%. So it's a little bit of a broader kind of earnings story right now, not just the Mag 7. You could look at the Mag 7 and say, this might be a situation where it's kind of buy the rumor, sell the news type of situation. But if you look at kind of the technicals, they were fairly extended. So I think this is probably a situation where maybe we see a little bit of consolidation through earnings and then kind of digest what's going on the economy.
If I could sort of articulate what the prevailing bull case was going into this week, let's say, it was not just that the overall trend had basically been strong enough that technically we were in decent shape. Cyclical stocks outperforming defensive stocks, financials kind of resuming leadership. Usually not bad things happen to the market when those things are in place. On the other hand, that's the kind of thing that could set you up for a growth scare. I mean, we did this last year, right? July, a huge melt up in Mag 7, and then you had this wobble in the jobs numbers. Everyone said, we got to cut rates. We didn't cut rates. And there was a bit of a tough couple of months before we did get the rate cut and everything resumed. So are we in for a repeat? I mean, what is the prevailing assumption on your part in terms of the macro?
Yeah, so I think on the macro side, I think we're paying attention to those economic data that we were talking about. I think the things that we are focusing in on from an implementation standpoint, somebody said this to me, it's impossible to predict the market, but you can prepare for it. And sometimes you can get lucky. We're doing our mid-year reviews, and you're looking at an equity market that's run pretty well. But one of the things we've been adding a lot to is in the private market, and we haven't talked about the private market has been exploding, right? We just had a very good IPO yesterday. While their private equity flows have actually been 50% of what they had been, we've seen some great pricing within the private markets as well. So from a risk standpoint, we've actually been reducing our equity exposure to get more in line, which kind of is just a natural cause with regards to how kind of expensive markets have gotten.
Okay.
But I think from our standpoint, we still think the fundamentals are pretty strong. So we're still kind of leaning towards that 7,200 with regards to next year's earnings. That still gives you kind of about a
7,200 for the S&P.
7,200 on the S&P through next year, right? So you're talking about a 319. 22.5 times. So you're talking about a 10 to 12% type of return, depending on how we close today. So you're looking at kind of a normalized return here. But I do think, to your point, we could see a bit of a pullback given how far we've come.
Gotcha. Chris, I have to leave it there. Thanks a lot. Appreciate the time today.
Thanks for having me.
All right. We did get some late breaking news out of Washington. President Trump calling for the firing of the Bureau of Labor Statistics commissioner just hours after the agency reported slowing U.S. job growth. Eamon Javers here with the latest on this decision. Eamon.
Yeah, Mike, that's right. The president taking to social media saying he's moving forward with the firing of Dr. Erica McIntyre, not a household name in Washington, but she is the commissioner of the Bureau of Labor Statistics. The president saying, I was just informed that our country's jobs numbers are being produced by a Biden appointee, Dr. Erica McIntyre, the commissioner of Labor Statistics, who faked the jobs numbers before the election to try and boost Kamala's chances of victory. He goes on to say, this is the same Bureau of Labor Statistics that overstated the job growth in March 2024 by approximately 818,000, and then again right before the presidential election in 2024 in August and September by 112,000. These were records. No one can be that wrong. We need accurate jobs numbers, the president says. I have directed my team to fire this Biden political appointee immediately. She'll be replaced with someone much more competent and qualified. Now, our Megan Casella has talked with folks at the White House, administration official telling her the president believes he 100% has the legal authority to conduct this firing, saying it's being done in this case because of concerns about the accuracy of the jobs numbers. The president accusing this official of political bias and saying that she's been putting her thumb on the scale for far too long. Mike, we'll see where we go from here, whether there's going to be a legal challenge to this and what the reaction in the market is to this idea of the president removing the head of BLS. And then, of course, the big question is, who will take the job next? Mike, back over to you.
For sure. And, just in terms of, whatever the market reaction might be is probably not going to be something we can discern, within an hour of this decision being made, big picture. But, it probably bears saying that, there are 160 million employed workers in this country. The job every 4 weeks is for this agency to go out and kind of poll a representative sampling of establishments and households and try to come up with a number that's kind of plus or minus tens of thousands on a given month. And, it can be made to sound pretty suspect, I guess, if you frame it the way the president does. But, this is a job that's been happening for a while, and they get revised for literally years after the fact.
Right. Yeah, I'm looking at some of the reaction on social media, Mike, from people who are the president's supporters who are saying, well, yeah, but they have these revisions, and if they're publishing these revisions, that means that they were wrong, and therefore they're bad at their job. But I think people need to understand the process of how the BLS does this. Those revisions are calculated every month on a rolling basis going back months and months. That's standard. The fact that revisions happen is not an indication that they got it wrong. The fact that revisions happen is an indication that they're trying to get it right now that they have more data in hand. Now you can say whether, is this even a calculable number at all, or is there some question about the process here? But to focus on the revisions and say that they have revisions means therefore they're not doing their job right is sort of putting the cart before the horse.
Right. Yeah, if you were making up a number, why would you go back and revise it? And we're saying, too,
why wouldn't you just make it up in the first place, right?
Yeah, that bigger revisions tend to happen around economic inflection points or, changes in tone. So, we have to be aware of that, too, Eamon. Thank you so much. Shares of Apple lower amid the broader market sell-off, despite a Q3 earnings beat last night from the company. Joining me now to discuss the print is Morgan Stanley's Eric Woodring. Eric, great to have you on. I wonder if, first of all, you just give me your sense of why the stock is reacting. Obviously, it's a sloppy tape, but if there's something your clients are suggesting gave them pause.
Sure. Hey, Mike, thank you for having me on. So, if we take a step back, I actually thought this was one of Apple's more impressive earnings prints in quite some time. You got upside to the June quarter results, even when you take away the fact that there was some pull forward and maybe some one-time benefit from discounting in China. Services was very strong. That was a key sticking point leading up into the quarter. Obviously, that accelerated. Gross margins were strong, and frankly, the guide for the September quarter was much better than expected. So all across the board, again, overall stronger than expected. I think the areas where maybe there's some nitpicking is there was some pull forward that benefited the June quarter. As we know, September is typically the quarter that Apple launches its new phone, and therefore it's really a sell-in quarter. And so the September quarter guide is maybe a bit more reflective of sell-in as opposed to sell-through. But really, when we take a step back, I think what we've heard this week and maybe over the last 2 weeks has been rhetoric more concentrated around tariffs. And as you know, right now, Apple has exemptions on tariffs for most of their main products, but Section 232 tariffs do pose a threat, and they are imminent. We would say if there's a, call it 15% tariff on semiconductor content for a company like Apple, that could be, on an annualized basis, something like a 200 to maybe 250 basis point headwind to gross margins. That's almost a 10% EPS headwind. So just to put things in context, my numbers went up 3 to 4% overnight, but that looming threat of tariffs still stands, and I think the market is very focused on that point because they are so imminent.
Tim Cook had a lot to say, at least in general terms, about AI and Apple's commitment to it. Also expressed a willingness to do more M&A. Is that satisfying investors right now?
I think it helps move the needle in the right direction, quite frankly. I think there's more that needs to be done, especially I think we need to learn a bit more about Apple's strategy really around building versus buying versus partnering. But the rhetoric around increasing AI investments, I think that's what the market wants to hear. Again, it's completely different than what we hear from the rest of the Mag 7, right? Apple's spending $3.4 billion per quarter on CapEx, not $20 billion plus. But that 3.4 is up from 2.9 2 quarters ago, and it is trending higher. So Apple's spending, I think investors like to see that. And then Tim, acknowledging that they are open to M&A. While I might not necessarily think that's going to be a lever they pull, at least shows that he's willing to consider a multitude of options to make sure that Apple presses forward on their AI strategy. Again, I think that optionality is what investors want to hear. So we took the proper steps forward. Still, clarity still needed. But that was probably the most transparent I thought Apple has been about AI on an earnings call, probably ever, quite frankly.
Yeah, we'll see. As you mentioned, there's a couple other potential catalysts or points of clarification coming up in this story. Your target 240. We'll see how it goes. Eric, thank you very much.
Thanks so much for having me, Mike.
All right, up next, the Dean of Valuation, Aswath Damodaran, is back. His take on today's big sell-off and where he sees tech valuations heading from here. Closing bell, will be right back. Well, it's been an ugly day for stocks as we kick off August, trading deep in the red. Here to discuss it is NYU Stern School of Business professor Aswath Damodaran. It's great to have you, Aswath. I mean, coming into this period after this very strong run we've had over, say, 3 or 4 months, did the market as a whole have a valuation problem, or did it really, change the risk reward looking forward?
I think the market has been bimodal. The first part of the year, I think the market built in expectations that things would get a lot worse. Then in the last 3 months, it almost seemed to switch and go in the other direction. The truth, I think, lies somewhere in the middle. And I think we're going to find out over the next 2 or 3 months where that steady state is. But I do think markets got a little overstretched over the last 3 months, expecting the best of things.
All right, and were there parts of the market that you felt as if just got either, overdone or were left behind? But, many of us keep talking about how it's in some respects an unbalanced market, just in terms of the massing of market cap in one area and in the kind of secular growth parts of this market. And yet, those secular growth parts of the market is where all of the upward earnings expectations have been as well.
I mean, if you look through April 8th, the Mag 7 stocks lost almost, 20% of their market cap, trillions of dollars in market cap. What's happened in the last 3 months is not only have they recovered that loss, but they've added another couple of trillion. The key word is trillion. I mean, we're adding magnitudes of value to these stocks that I don't think they can sustain given the economy, given the company's own capacity to generate earnings and cash flows. So that's what I mean by overstretched. I think that, these are great companies, but they're not as great as the market thinks they are in terms of what they're bidding up the market cap to.
You mentioned that by most lights, I suppose, the economy had been holding up better than many would have expected, given the tariff overhang and even the tariffs that already have been imposed. Does that still seem to be the case in light of today's jobs numbers and some of the consumer spending data we got this week?
I think here again, the market was never as bad as people. I mean, the economy was not as bad as people thought it was going to be on April 8th. And it was never going to be as good as people thought it was even last week or earlier this week. So I think we're going to get more reports like this where we go back and forth between the optimists who say, hey, this is going to be okay, and the pessimists who think that this is just front-running what's coming with tariffs, and you're going to see a much slower economy in the rest of the year. And you're going to see these reports come back and forth, and the market is going to be whipsawed every time a report comes out in terms of whether it's good news or bad news.
I'm fascinated by, you mentioned that just the trillions of dollars in market cap that have been kind of added to and occasionally subtracted from that small group of stocks. When it comes to NVIDIA in particular, which did peak at around a $4.4 trillion valuation before this little pullback, I mean, the volume of dollars added to the top and bottom line by this company is I think, unprecedented in a short period of time. It's going to be $250 billion in revenue next year, it appears, and about half of that falling to the bottom line. Is this the kind of thing? I mean, how do you treat that in terms of, do we extrapolate that as the run rate? Do you give it a premium for that, or do you assume that it's going to have to just revert to the mean?
Oh, we're not just giving a premium, we're giving a super premium to it right now. I think nobody is contesting the fact that NVIDIA is an amazing company. Jensen Huang is a great CEO. I think the question is, how great is he and how amazing is it? Because what the market is doing is building into the market cap, I think, expectations that are going to be really, really, really difficult for even NVIDIA to meet.
Yes, and in fact, there's going to also be a time when I think investors are going to have to ask, what are you going to do with all the cash and the free cash flow? And can you deploy that in a profitable, high return way. We did get another pretty enthusiastically received IPO, the software company Figma, yesterday. I don't think the overall market has certainly had a supply problem in terms of lots of new issuance, but there have been pockets of exuberance that have seized on some of these new ideas. How do you filter that into, your view of the market environment?
Well, I'm going to go back to 2022 when risk capital left the market. In what sense? IPOs stopped. People were not willing to buy high-yield bonds. In 2023 and 2024, the market came back, but risk capital didn't really make its way back. It just parked its money in the big tech companies and wasn't willing to buy into IPOs. I think the story with Figma is less about the company itself and more about the opening of the door, perhaps, to more IPOs coming out. And you're right, they're going to be concentrated in the buzzy areas. A lot of AI IPOs are probably waiting to see how Figma does. And given how well it's done the last couple of days, I wouldn't be surprised to see a lot more IPOs hit the market in the next few months.
Which is the kind of thing, I suppose, in a bull market that is sort of an energizing factor initially until perhaps it gets to get overdone.
Exactly. And that's, I think, the question is, as you see these new IPOs come out, how much will they stretch the market? Because, one of the signs of market exuberance is when you see IPOs of companies with no business models and essentially potential that is not there, and they get bid up just because they're in the right space. So it'll be interesting to see what happens in the next couple of months. But you know what? A market correction in the next few weeks will very quickly put that IPO market to sleep again.
Yeah, not to mention, August is often slow, so maybe we'll kind of reset ahead of any issuance boom that we may get. Aswath, great to speak with you. Thank you very much. Now in the closing bell market zone, and we are all over today's big market sell-off. HSBC's Max Kettner and John Kolovis from Macro Risk Advisors here to help break down the final moments of the trading day. It's great to have you both. John, tee us up here in terms of, what field position you think the market was starting this month from. I know you thought that maybe the rally was culminating. What are you seeing in today's action?
Yeah, I think, Mike, we're in the early stages of the corrective process here right now for the equity markets. Like you said, the setup was there, momentum was overbought, complacent sentiment, seasonalities, valuation, you name it. But today, we really got a strong whiff of supply coming into the tape. The gap lower in the S&P today undercut short-term moving averages, and what it did was it created an island reversal. And when those happen, when you follow the charts, you got to take pause and turn down the volume. But what really stands out in today's statistics is that there was a big spike in 20-day lows to 40%. When you go about 2 to 3 months without a big spike in new lows, and then when you get it, that's either at the very beginnings of the topping process or at literally the beginning of the decline itself. So we saw that in December of last year. Market went sideways and then rolled over. And then we saw it exactly when the market decided to fall apart in late February, early March. So I think that we're in the beginnings of the corrective process. How the market behaves around this 6,200 level will be important. If we break it hard, then I think it's going to be more of a direct move lower, not only to the 50, but we'll probably make a run towards the 200 at around 6,000. If it's more of a benign break, yeah, it'll probably be more of a churn, sideways sort of thing. But overall, I'm viewing this more as a pullback within an ongoing bull market. Still think 6,600 before the end of the year.
All right. And Max, are you newly focused on the potential for downside risk? And did the fundamental story shift at all for you today, either with the jobs number, with yesterday's personal spending, or anything else that hit this week?
Yeah, look, when we look at the earnings numbers this week, actually, the earnings numbers look pretty good. So from that perspective, actually, not an awful lot has changed. I would say, indeed, when we look at some of the big AIs, some of the tech names, their reporting was very, very strong. And of course, we are still seeing very, very strong AI CapEx spending numbers as well. So I do think bottom up, also the AI story is still very, very much intact. That should be helping, particularly the US equity market. Obviously, the weaker weaker dollar should still be helping also U.S. earnings, and particularly the mega cap earnings. So from that angle, I don't think an awful lot has changed. I think the labor market today really was a bit of a shocker, right? Like, let's be honest, when we look at those kind of revisions, these are sort of the revisions that we were used to during peak lockdown 5 years ago and during COVID, but not during normal times. It raises, of course, also the question around data quality. It raises the question whether both us as analysts, but also policymakers, are now being at risk of sort of making, making policy decisions or making recommendations on the basis of, I wouldn't say false data, but really data that are heavily prone to revisions. That is, I think, an ongoing question, particularly with the cuts to funding of agencies like the BLS. But I do think what it also does going forward, it does actually lower the bar, number one, for perhaps some of that hiring coming back, right? That is number one, with a bit of more clarity now around trade policy. When we think about, the Japan deal, the EU deal, perhaps a bit more positive news around the China deal as well. So that should give a bit more clarity to companies. That should also perhaps give a bit more confidence back in terms of hiring. And it should also give a bit more confidence in terms of investment, in terms of a bit of a comeback for investment in the second half. Both of these things are actually still things that keep me pretty bullish.
And I guess, Max, you're talking in particular about just the challenges to data collection and the lower survey rates, and maybe there was this, sort of leaving the numbers more susceptible to revision, not what we heard about this afternoon about the president potentially firing the head of the statistical agency.
Yeah, I think that's more that one. It's not really related to firing the head of the agency. Yeah. It's more perhaps around, staff shortage as well, right? That basically, I think in the BLS, the cuts to staffs was around 8%. That was in the original bill. All of that obviously doesn't help in terms of data quality and data collection. That is something that we really need to be mindful, I think, in the next, not only in the next month or two, but really in the next couple of quarters. And does that make us more susceptible to very wild swings in terms of revisions, and does that make us susceptible also, again, to make sort of recommendations on data that is heavily prone to revisions, and also policy decisions, and also policy pricing, which also introduces sort of quite unwarranted volatility in markets then, of course.
And speaking, John, of volatility in markets, I mean, even though we're like less than 3% from the highs in the S&P, and as I mentioned earlier, the markets tried to bounce off of 6,200 a couple of times today, the volatility index has had a bit of a pop. It's up 4 points. It's above 20 again. Is that telling you something about, whether it's a change in character of the market, or does this rush to hedge mean that we're just kind of rebuilding the wall of worry and we're going to give way to another dip buying and rotational type tape?
Yeah, it's great to see VIX finally do something. I mean, clients today were very excited to see the action within the VIX. I think what it's reflecting here is not only just a growth scare in the market, but what you guys were hinting on a second ago, about, Trump trying to fire people. It's just not a good look. So what it's doing is it's bleeding into credit spreads spiking today. And I think that's an important consideration. It will be a change of character, to your point, if it persists, if the CDX spreads, they're already spiking today, and we see follow through on that, it's going to bleed into the equity markets. And my idea of it holding 6,000 might not happen if we see continued acceleration within credit spreads. So financial conditions have been fantastic all year. That has to stay, because that's really the main point here for all of us, whether you're bullish or not. So those credit spreads really do need to control and stay down.
Mm-hmm. Max, you certainly note that the actual earnings performance has been quite strong, and big beat rates and a wide margin of outperformance by most companies. What do you take away from the fact that the market as a whole hasn't really been able to pull any strength from all that?
Yeah, look, I guess there's been, of course, also some of the not very supportive political news. Think about yesterday around the healthcare sector, of course. That's been overshadowing, or more than overshadowing, the good numbers from Meta that we had, for example, also from Microsoft. So I do think it's not just about, okay, you know what, the market's not gone up. Why is it not gone up? So definitely the market is not rewarding any of these earnings beats. No, that's not the case. I think it's just that those single name stories or those political stories that have been flaring up over the last couple of days, they've been sort of overshadowing it. Is that really going to continue? You know, to your guys' points around credit spreads, I'm very skeptical on credit spreads really blowing up much further. I am much more sanguine about that in terms of credit spreads as well, because the technical picture, particularly in US credit, particularly around default rates, both in Euro credit and US credit actually, but also around refinancing needs, around the maturity wall, around index credit quality, all of these things are so much better. So that leaves us with a technical picture, particularly in credit, both in IG and in high yield, so much better compared to 10, 15 years ago. And that really should be somewhat softening the blow, I think, in terms of credit spread widening in the next couple of days and weeks.
Yeah, a lot of talk about how the private markets have taken away some of the more suspect paper, and you know, we have a bond market that's in a better shape. And speaking of bonds, John, I mean, the Treasury bid today has been very strong. Yields have come in. Do you see anything there that's telling us about how that's going to go in the future? Can you actually, hide in Treasuries for a bit?
You probably could a little bit. I mean, the trend really has been sideways for the 10-year, stuck between that 465 and that 410 area. But today's move, I think at a minimum, tells us we're not going to see 4.5 anytime soon. And same with on the short end of the curve. Now, the short end of the curve looks as though it's going to be capped, underneath that 390. My sense is once we see a clean break of the July lows on the 2-year, we'll get down to around 3.5. So yeah, I do think that the short end of the curve it's going to work itself lower in terms of yields. But yeah, heck of a move today, an outlier move, and you got to respect it.
Gotcha. John, Max, really appreciate the time today. Have a good weekend as we head into the close. The S&P 500 is still sitting on about a 1.6% loss for the day. It's been around that area for a while. It did bounce up 6,200. That was the low from last month. The small cap Russell 2000 down 2%, bearing the brunt of that bad job support. Does it the closing bell now. Let's send it over to overtime with Morgan and John.
Well, that's the end of regulation. AB InBev bringing the closing bell at the New York Stock Exchange. The Chicago Innovation Award winners doing the honors at the NASDAQ. This was not a sleepy summer Friday, folks. Stocks in the red. Down day for the major averages. It was a down week, worst week for the S&P and the NASDAQ since May, for the Dow since...
Hey, I'm George. This is Blue Cloud Trading, and it's Sunday, August 3rd. We're going to take a look at some of the stocks that they talked about on closing bell this last Friday. In fact, there's about 19 stocks, and they're all in the green. Unlike the market that was down, I picked the ones that were actually up for the day that were displayed on the screen. So we're going to look at a lot of those, like Gilead, Walmart, Merck, McDonald's, Coca-Cola, Verizon, some big names. And we'll look at the index ETFs here, including the European one, FEZ. We'll look at some of the Mag 7 stocks, and we'll also take a look at some of the sectors as well. All right, let's get into it. So starting off with the markets, how did they perform on Friday? Obviously not that great. You can see that the Dow was down 1.23. It gapped down and stayed at these levels, right? NASDAQ was also down 2.24%, gapped down and stayed again, kind of stabilized for the rest of the day at those levels. Same thing with the S&P 500 down 1.6%, and the Russell 2000 was down 2.04. Let's take a look at the heat map. That's going to show us how the individual stocks within the S&P 500 performed, and you can see that basically the majority of technology stocks were down. Google and Meta were down. Amazon, Tesla were down. Look at Amazon down 8.27%. The financial stocks were down except for Berkshire, which was up 0.20. We're going to look at that stock. And a lot of the healthcare stocks actually performed quite well. Utilities, for the most part, were okay. Consumer defensives as well. And if we look at the 1 week performance, this is what it looked like. So even, just for when you look at the entire week, Meta was actually up 5.24%, Microsoft up 2.02. So out of the groups, which ones did, perform the best on Friday? It was consumer defensive and healthcare, and utilities up 0.06%. So let's look at these ETFs first, the SPY. Let's start off with these, and then we'll take a look at those stocks talked about on CNBC. Here's the S&P 500, as I mentioned on Thursday. right? I did a video on Thursday, the last video that, one prior to this. I said, guys, watch out. This is when price closes under the Tenkan, it certainly can lead to a pullback like it did over here in the past. It pulled back to the Kijun-sen. In this case, we had a big gap down on Friday. Okay, that was the first signal of weakness in the market after this big, long, extended trend up where the price closed under the 9 period, the green line there, of the Ichimoku indicator, which is what we're using here. And price closed under the Kijun-sen, it's more than likely now to pull back some more. And my expectation is it's probably going to come back to these prior highs here, around 613.23 at least, maybe. And we're talking about at least another 1.4% or so. That's just my expectation. I mean, look at the volume down below here. See how it steadily started to increase, okay, as price was in the negatives. And I mentioned that on Thursday too. And there you have it, basically a continuation of that decline. Another couple of things that I'm not looking that great here is the negative DI here, for example, crossed above the positive DI. And that's usually also a very negative signal. Not always. It can be short-lived like it was over here. You can see that the negative DI crossed. But in this case, where the price actually closed under Kijun-sen, we could see a little bit more of an extended pullback now. What about the weekly chart? What does that look like? Well, on the weekly, we're still basically in safe territory as far as being above the moving averages in the Ichimoku cloud. But we did develop on Friday a bearish engulfing pattern. It's these two candles right here. And I've talked about that before. Let's take a quick look at that pattern. It's a bearish double candle pattern. So we're going to look over here, and there it is. So you can see that small bullish candle followed by a much larger candle, okay, and that engulfs it. Hence why they call it the bearish engulfing. So that's what we've got right here. Not a positive sign there, okay. How about the QQQ ETF? Same thing, bearish engulfing on the weekly, on the daily chart also getting under the Kijun-sen. Okay, same situation. Dow Jones, okay, same thing, down 1.27% under the Kijun-sen, which is the red line, which is the 26 period moving average. And it looks like the faster one's about to cross under, potentially. We'll see if that's true or not. Here's the weekly chart, also another bearish engulfing type pattern, but it did stall at the Tenkan-sen, so that's a positive. The Russell 2000 stalled at the 9 period, aka Tenkan-sen, and it's under the Ichimoku cloud, so that is not good. But the fact that it did stall is a positive. So the fact that it stalled right there, and there's just a little bit of buying that happened towards the end of the day. If we switch it, I'm sorry, that's the end of the week. So if we look at the daily chart here, and we look, for example, at let's look at a 10-minute chart. Yeah, you can see that it pulled back, and then from this low, it did move up. Let's see, about 1.23% on August 1st. Okay, so it did close up basically above the lows of that day of August 1st, around 10:10 a.m. Now, it doesn't mean that this is a time to be adding new positions, though. And what about the VIX? The VIX, which represents the volatility in the markets, as I mentioned, we saw an increase where the candle got above the Tenkan-sen there on Thursday, and here was a continuation, basically entering the Ichimoku cloud and then dropping back a little bit. This is not good stuff, though. In fact, it's a big jump, 21.89%. We'll see what happens on Monday. Obviously, FEZ, that one also pulled back further, down 1.24%. Got under that support level of 57.67, developing a slightly bullish candle with see that lower wick there? How it's that represents almost like a hammer type candle. So we might see a potential bounce maybe on Monday, but I would not be adding any new positions here for sure. IBIT, Bitcoin, ETF also closed under the 26 period, the red line there. It's under that trend line still. That's not good either, okay? So we'll see what happens. You can also, if you look below here, the negative DI crossed above the positive DI. Volume increased a bit more. So that is not a good sign, but it did hold up above that 63.70 level. So there's still quite a few support levels, all right, for the indexes, index ETFs, Bitcoin, and the European ETF as well. All right, let's take a look at those 19 stocks that they talked about. Well, they didn't actually talk about it. These are just stocks that popped up on the screen that actually performed well. There were other stocks as well that were down, but I thought, hey, let's focus on the ones that were actually up today, on Friday, that is. And let's see how they, like, whether or not it makes sense to even consider these going into next week. All right, that's the idea here. And what I'm doing essentially is going to be looking at the charts on the weekly and daily timeframes on all of these 19 stocks. And at a glance, which is what Ichimoku stands for, within a glance, I'll be able to tell you guys if it's strong on both time frames so that it makes potential sense for next week, right? By the way, I've already done the homework here, and I can tell you right off the bat, there's only two stocks that really met those requirements. GILD is one. Gilead Sciences, here it is on the daily chart, still strong trend. We've got a bullish harami pattern as well right there, those two candles. It's the red larger candle followed by a smaller candle within the body of the prior one. That bullish pattern, we'd have to go over here on the left-hand side, look under double candle patterns, and there is the bullish harami right there. Okay, that's what we've got here. It looks pretty bullish. Here's the weekly chart, still holding up above the moving averages. Still under that 119.96 level, though, that high. If it breaks through that, that's going to be a little bit more of an optimal entry point, in my opinion. WMT, Walmart. Okay, here it is in the weekly chart, up 0.52% on Friday. You can see 3 weeks in a row it's been steadily moving up. So that's interesting, right? ADX is still looking positive here. And on the daily chart, same thing. We also had a recent crossover, positive crossover. The faster moving average crossed above the red line there. The green is above the red, and it's above the Ichimoku cloud. Everything is looking pretty good. I like what I'm seeing here. Let's look at REGN. That's at Regeneron. On the daily chart, it's under the Tenkan-sen. But it is above the cloud. On the weekly chart, it's still in a very, very long and depressed state here because it's under the cloud. And you don't want to be adding positions in any stock when price is under the cloud on the weekly, all right, or on the daily. So, like, you know, if you got negativity on one time frame, just skip it. There's other opportunities, there's other stocks or ETFs that are bullish on both time frames, which will give you a better probability of success in your trading. So REGN under the cloud, under the moving averages here, under the Kijun-sen and 200, but it's technically above the Tenkan-sen. So that's not a good one. BIIB, Biogen, on the weekly chart, still in this look at this, guys. How do you know that this is going to be the turnaround for this stock? Just because it was up 3.09% on Friday? That's just 1 day of action. Since it's been under the cloud here, which is where it got under, it's dropped 44. Okay, I'll just highlight. Hold on one second. I'll hide it from that point there. It's down 44.3%. Since it closed under the Kijun in the 26 period, right there, it's down 54.13%. And it doesn't look like it's this trend has stopped yet. So stay out of that one. Here's a daily chart, which shows a little bit of bullishness, but again, you're taking a big gamble there. EA, Electronic Arts, this one here, showing a little bit of strength. It was up 3.01%. It's above the moving averages, but the faster one is under the slower one. On the weekly chart, it's actually pretty bullish. All right, I had a small position here of this stock, and I had just a small profit, 4% on that trade there. Merck, how's that looking? Well, on the daily chart, it's under the cloud right now still. It's right there. On the weekly chart, it's also under the cloud. So no on Merck. Home Depot, under the cloud on the weekly, above the cloud on the daily. So we don't have confluence there. So I'd skip that one. Sherwin-Williams, inside the cloud and under the Kijun and under the 200-day. So no on that on the daily. Here it is in the weekly, still not looking good either. McDonald's, under the Kijun, the 26 period. It's above the cloud. All right, but the faster moving average is still under the slower one. And on the daily chart, it just is inside. It's still inside the cloud. So this one might potentially, we might see something happening within the next week or two, but I wouldn't jump in there yet. Coca-Cola is still in a decline here on the daily, under the cloud. No on that one. Verizon, On the daily, it's under the cloud. No on that. Okay. Let's look at the weekly chart. It's kind of stuck in between the two moving averages. No on Verizon. Amgen, on the weekly chart, inside the cloud. No on that. On the daily, it's above, but it's under the Tenkan in the 9 period. So no. Eli Lilly on the daily chart is under the cloud. On the weekly chart, it's also under the cloud. So no on Eli Lilly. But it was up 3.01% on Friday. AstraZeneca on the weekly chart inside the cloud. So we don't add a position here, even though it does starting to look a little bit bullish on the weekly. All right. So I do kind of like this compared to a lot of these other stocks that I've just showcased. But it did come back. Notice how it pierced the Ichimoku cloud. And that it created that wick that shows the high of the week. And then it finally closed back inside the cloud. So there's we don't have confirmation yet on the weekly. On the daily chart, it does look pretty bullish, though. You can see that it's above the cloud, above the moving averages. It's starting to look more and more bullish. All right, let's keep going here. Let's look at Vertex Pharmaceuticals. On the daily chart, it's inside the cloud. No. On the weekly, it's under the 26 period. No on that as well. LRCX, which is Lam Research Corporation, the semiconductor equipment and materials. On the weekly chart, looks very bullish. We get a future bullish cloud here, a higher high. It's above the moving averages, but on the daily chart, it's pulled back, but bouncing off the cloud. So we might see it pop back above soon. Costco is under the cloud on the daily. No on that one. Ontario. On Semiconductor Corporation, semiconductors, right? So this one is pulled back a little bit, finding support at the 200. It might pop again back above. Let's look at the weekly. Still under the Ichimoku cloud. It needs to break through that 200 day, in my opinion, first. Berkshire. Okay, it's pulled back, but still above the cloud. On the daily chart, it's still under. So no on Berkshire Hathaway. Berkshire does not, even though it was up 0.20%. Berkshire, since it broke under the Tenkan, which was right back here on May 5th, it's dropped 9.23%. All right, let's take a look at some of those Mag 7 stocks, like Meta. Here's Meta. It gapped up on Thursday and then pulled back, all right, to the support level of 740.91. It's still technically bullish overall, okay, on the daily and on the weekly chart. But it's just showing a little bit of weakness here, along with the rest of the stocks, due to the tariff situation. Apple, here it is on the weekly chart, under the cloud. No, I've been saying this for a while now. Stay out of Apple. Here's the daily chart. Look at that big red candle. Volume increasing. Okay, down 2.5%. Here's Tesla. I've also been saying to stay out of this one. Here it is on the daily chart, inside the cloud. Here it is on the weekly chart, still under that trend line, under the cloud. No on Tesla. What about some of these sectors here? We'll take a look at some of them here. Well, Bitcoin, for example, is still above. Now, Bitcoin, unlike the ETF, it does look still technically sound here on the weekly chart. Actually, the IBIT does too on the weekly. Let me look at that again. Yeah, on the weekly chart, it still looks okay. On the daily chart, let's get back to that Bitcoin for a moment. On the daily chart, though, it's under the two moving averages. Okay, so I would not be adding a position yet. XLK broke down. That's the technology ETF. All right, so it closed. Not only did it close, but first it gapped down from this low. This closing price. It gapped down to that level, and then it continued to drop. So higher volume, looks like the negative DI is about to cross the positive DI. We might see a pullback here. And the next level of support is around 241.88. That's about 5.74% away. Utilities, on the other hand, XLU performed quite well, up 0.15% on Friday. And it's been in a strong uptrend since. Here it is in the weekly chart, holding up above that 83.41 level. The rest of these are not looking that particularly great, but I'll kind of skim through these real quick. XLB, for example, inside the cloud, no. Copper, no. You can see it's under the moving averages. Same thing with GDX. Communication services, same thing. There's that. We talked about IBIT. SMH also just kind of pulled back under the moving averages, but created a nice bullish candle. So semiconductors create a bullish candle doesn't mean that you should be adding positions, though. New ones. GLD is still stuck in this consolidation stage. You can see the little candle right there is still inside the cloud. Real estate's inside the cloud. No. Oil K, same thing. Consumer discretionary, no. Healthcare. Now, this is where it gets interesting because on the daily chart, healthcare looks pretty strong here with XLV. All right. Now, I did a much deeper analysis of the sectors over the weekend. I do a members-only video. It's usually about an hour long. And I go over my entire portfolio. I go over all the sectors. And I do a drill down, basically. I also provide 20 new stock ideas for the upcoming week, looking at those strongest sectors. So I gave some great, I believe, good ideas for this coming week, mostly in the utility sector as far as stocks. So you may want to check out that video. It's real easy to become a member. Let me show you guys how you do it real quick before we continue. You come to the Blue Cloud Trading page here, and then once you've subscribed, or you can scroll down a little bit. Okay, right over here where it says Our Members, you can click the Subscribe Plus button here, or you can click it here. Now, if you just hit it once, if you're not subscribed yet, it will just allow you to become subscribed to the channel, and that's free. But if you want to get the extra content, you double check it, right? Check it one more time, and it will pop up this little box that you see here. You can either become a Blue Cloud supporter, and I appreciate all of you guys who have become Blue Cloud supporters. Blue Cloud Trader level, this is where you'll also get access to those exclusive member-only videos that I do on the weekends. So that's the next level up. Now, if you want even more stuff, okay, more perks, the Blue Cloud Legend level is the highest one. And under this one, okay, you'll get those same exclusive member-only videos. You can request 3 stocks or ETFs be analyzed on a upcoming show. There's some day trading videos that are not available for Blue Cloud traders there. There's also daily trade updates. I think this is the most key thing, where I basically update the members about my trades daily. And usually what will happen is once you've become a member, there'll be a new tab that pops up over here next to posts, and it will look like this. We'll see the membership. That's where I post those trades. And so, yeah, I closed out of a lot of positions this last week. I added, less positions than I closed out of, and it was a very profitable week. I only had one losing trade, and I forget how many profitables. Let me check real quick, and I'll come back here for a moment. So here's a summary of the positions that I closed out of right here down below. You can see the percentages that I made on each trade. Okay, I am blanking out this segment, which has the 7 new positions that I added that week. And I talk about that, why I added them. Consider becoming a member. You'll be able to access this information, okay, along with those 20 new stock ideas. All right, let's get back to the sectors here. So XLV looks pretty bullish here on the daily with this pattern, but I would not be adding a position with XLV necessarily, even though the healthcare sector overall is pretty strong. There's a lot of strong stocks within the sector. This ETF is not quite there yet. Okay, you can see it's still under the cloud. XLP, same thing. Industrials is under the Kijinsen, it looks like almost now. Yep. Closing price 149.74. It's technically right above just a little bit above the baseline, or the Kijinsen as they call it. 149.62 is the red line. So it's slightly above it, but it's not looking that great. Financials also, XLF. See how it came down. Maybe we'll find some support here at the cloud. Energy, re-entered the cloud. So no on that one. XHB, home builders looked a little stronger on Friday, up 1.91%. But if you look at the weekly chart, it's still under the cloud. And GDXJ is under the cloud. I'm sorry, under the Tenkan-sen on the weekly, and inside the cloud on the daily. Guys, thanks for watching. Thank you for supporting the channel. If you guys also like the software that I'm using, it's called TC2000. You can actually get a $25 coupon for this software. Really easy. Again, just come to the Blue Cloud Trading. Click on this right here. It says 9 more links. You'll see a little bit of information about me. Scroll down a little bit. There's the link right there for the software. You enter your email once you click on that, and you can find out about pricing and all that. I also have a Patreon channel. I have an X page, x.com/bluecloudtrader, where I post things daily there. You might want to check that out as well. You can also, from here, you can actually find, let me show you guys how you can get that cheat sheet as well. Okay, scroll down right here under highlights, click on that, and then scroll down a little bit. And where is it? There it is. Okay. I think you can download it or upload it from their candle pattern reference sheet, plus this stock patterns cheat sheet as well. All right. Thanks for watching, guys. I will catch you all in the next video.